this is a discussion about impact investing. Just to give you a little bit of context, it's been estimated now that the impact investing market value is about $228 billion US, which is a fivefold increase, I believe, since 2015. But we also know that, for example, there's an estimated $2.5 trillion investment gap for emerging countries to be able to achieve the Sustainable Development Goals by 2030. So there's a huge area that still needs to, a huge range of opportunity and necessity that means that we need to grow this so-called impact investing market value much greater. We know, for example, that institutional investors are sitting on about $100 trillion of assets globally. So, Nena, how do you, in the work that you do, which is both you're making your own direct investments through the IFC, you were telling me backstage that over more than 60 years that IFC has been in business, that IFC has made $225 billion alone in impact investing, and your current portfolio is $57 billion. And you're creating mechanisms, tools, ways to both invest your own capital, but also to bring in private investors and other government entities. So how do we get to that greater number, because we know the need is so high?
Thank you very much, Mark. You already put some numbers out there, and representing one of the largest development institutions focusing solely on private sector development in emerging markets. It is my pleasure to be here at this closing session and talk a bit about impact investing. You're absolutely right. I think the market for impact investing right now is fairly small. And it's kind of very exclusive. Only several development financial institutions and some impact investment companies actually are active in that market. And as you pointed out, I think the Sustainable Development Goals that are all set to be completed by 2030 have pushed us all into the same direction. I think the number that you quoted is probably a bit underestimated. We need about $7 trillion per year to invest to implement the SDGs by 2030, and about 7 trillion per year, and about 4 trillion of that, some people say 3 to 4 trillion, will have to be in the emerging markets where we still have high poverty rates and a lot of lack of access to key services. So we know that we need to do something about it, and we would love to bring more impact investors into this space, but especially, as you said, institutional investors who have a lot of funds to invest but are not yet coming in. What IFC has done is to standardize the approach to impact investing and to come up with principles and certain definitions that will be widely acceptable. And that would be a starting point to actually have some common parameters on what are we talking about when we talk about impact investing. And during the spring meetings of the World Bank in April, we will announce these operating principles for managing impact. We have worked on them with a number of partners, development financial institutions, some asset managers, asset investors, and we had a bit of feedback process over the last 3 months to make sure that we are all aligned. So we will announce those principles, and they will include some common definitions, common approach to risk and returns, approaches to exit. And this would not be the first time that we have led on those principles. I think a similar example was what we did in 2003 when IFC came up with performance standards for environmental and social performance of our clients. which was accepted then by 94 commercial banks worldwide in 37 countries who are all using the same standards that our respective clients have to fulfill. And I also want to say that IFC is probably one of the largest impact investors in the world. The numbers that you quoted are $225 billion of investments are over the 62-year period across a number of sectors, primarily in emerging markets. And we keep thinking about how to quantify, how to measure impact. And recently we developed a new tool that we call AIM, where we are trying for every single project that we invest in to have an ex-ante measurement of impact. Impact on employment, impact on communities, impact on environment, and then impact on the sector where that project sits. So, and that's a single number for each of the projects, which allows us to aggregate all of our projects and their AIM scores. So that's quite novel in the development world, and I'm sure that the impact investing principles that I talked about benefit from this new tool that we have developed.
I'd like to talk a little bit more about those principles, because I think the point that you make about, you know, what are we actually talking about when we talk about impact investing? There are a lot of different definitions. There are some trendy funds, impact investing funds that are out there. But as you just pointed out, last fall in Bali at the IMF World Bank annual meetings, I think that's where you unveiled the drafts of these principles. And then, as you said, next month in Washington at the annual meetings in the spring, you'll I think unveil almost 50 CEOs who are signatories to this. Do you want to give a sneak peek of who might be signing on to any of these?
I think you will see a lot of development finance institutions, all the regional development banks, and some of the kind of bilateral development banks. You may also see some of the well-known institutions such as Rock Creek Group that has worked with us on those principles, those who already have invested a lot of funds in emerging markets and in impact projects.
So how do we know, I mean, you talked about ways to measure this, but how do we know that impact investing is actually making the impact that it's designed to do? How do we know, for example, that green bonds are not just greenwashing? And how can investors know where to go?
I think that those principles will help because I cannot talk about the implementation of the principles because they are new and they are going to come out very soon. But I can talk about implementation of some other principles. When we set up those performance standards for environmental and social and governance performance on our clients, we know what they are. IFC would not invest in a company that doesn't adopt those standards. And not only that we want the company to adopt them, we also help them implement them and help them come up with action plans on how to become more environmentally and socially sustainable or govern better. And then we monitor that through our supervision. So it's not a one-time thing. Many of those projects, many of those companies need capacity to implement some of these requirements, and then we know it by monitoring it over time. I also wanted to link environmental and social sustainability and impact with financial sustainability. IFC has been trying to demonstrate over the 60+ years of its operation that only financially viable projects can be impactful and sustainable, because that's the only way that you can continuously employ people, that you can continuously train people, that you can continuously support communities, engage with communities, etc. Because bankrupt projects are not going to create any impact. So there is a very strong link between financial sustainability and environmental and social, economic impact.
So taking the green bonds as an example, I mean, the green bonds are one thing, but it's what they are actually used for on the ground that also matters, and making sure that those projects are green.
Absolutely. I mean, Mark, you and I can come up with a new green bond, and we can call it green bond, but what actually matters is what these bonds will be used for. And this is again where there is perhaps not yet a common standard, although there is something called International Standard for Green Bonds. And IFC is very pleased to be on the committee, international committee, that has come up with those standards, and also very pleased to support quite a number of green bonds in the Asia region with both banks and real sector clients and their issuances. So when we are involved, we know that they are really green because they have to, the underlying projects have to fulfill certain standard. They have to be green in nature. They have to make a positive climate impact. And I think the sectors where normally those green bonds get used, and I go now to our discussion on climate change, this is where we see great opportunities, including in Asia. One is climate smart agribusiness, especially use of biomass for energy, where there are a lot of emissions of greenhouse gases. And then the second sector is also very prominent in this region, renewable energy, all renewable sources, solar, wind, hydro. And we also found some platforms and mechanisms on how to scale certain solutions in solar, for example, by using similar contracts and PPP arrangements with the government so that we can scale this across multiple countries. And then obviously in the region where urbanization is so prominent, clean cities, green cities, clean urban transport, obviously with the way how we manage waste, water, energy efficiency. This is another big area in Asia. And the fourth one is green buildings. That's now becoming one of the larger components of many of the green financing schemes, because we see a lot of construction going on, and we want to make sure that a lot of that construction is actually green. IFC went that far to actually develop a tool for developers that we call Edge, that's helping developers and construction companies develop greener buildings by changing some materials, and they can actually, by using this tool, estimate how much greener their building will be. And when I say green buildings, I obviously talk about housing, but it can be hospitals, shopping malls, etc. So those four sectors are mainly beneficiaries of the proceeds that are raised through green bonds everywhere, but I think in this region in particular.
Right. So arranging the financing or creating the financing is obviously key and an important part of it, but having projects then to invest in that are properly structured and that that are sustainable, to your other point, I was just struck by what a challenge that is. There's one example that you and I talked about before that I wanted you to explain to our audience, which is this hydroelectric plant in Nepal, which I think really that story kind of encapsulates the difficulty, I think, and the hard work necessary to make impact investing have true impact.
Yes, no, you're absolutely right, Mark, because the world has realized through SDGs how much gap we still have in terms of development and impact, how much of impact investments still have to happen so that we bring those trillions every year, in particular to the emerging markets. And we talk a lot about the financing, kind of the end game, but we in the World Bank Group in general, and more specifically in IFC, we have moved more onto what is the financing going to be for? Because if there are not enough projects properly structured, we will struggle to bring the private sector in. So even if we have the financing available, and again, institutional investors sit on quite a lot of funding, if there is nothing to invest in, then those investments will not happen. And we spend a lot of time on what we call project development, creating markets, working with regulators, with governments to regulate the sectors in a way that private sector can come in. And the project that you're mentioning, the largest foreign direct investment in Nepal so far, is called Upper Trishuli 1. It's the 216 megawatt hydropower plant, and it's the first one ever that's in Nepal that's structured as a commercial deal, where a Korean sponsor is investing and has been very patient, as we worked with the government to come up with a bankable power purchase agreement. It took us 8 years to reach this particular point, and this project is in fact going to our board tonight. So I'm quite excited about the anticipated board approval later today, and then hopefully the financial close that we will have in the next few months. But that's just the beginning of the implementation. Implementation itself will take years. So I'm talking about one single project with a huge impact that's going to take at least 10 years from the idea of doing something like this to working through all the steps and then implementing it fully so that it starts generating power that we need, and let alone other things that are needed in Nepal, including the work on more hydros and then transmission, distribution and transmission. And so in a country that has huge potential in hydropower. That's just one example, but we have many of those. So we are in a very difficult business. It's hard, and it's not always going to be successful.
So if you were talking to some large institutional investors at this point, what would you say to them about why their capital is not only obviously needed, but that it can be put to good use, both for their shareholders, their investors, as well as for the recipients of that money?
I think we also see, as I said, all the focus on SDGs is making many investors, including institutional investors, more interested in ESG in particular, but also in development in general. So what we want to tell them is that there is money to be made in emerging markets, in some of these challenging projects. Again, IFC is clear evidence of that, because for 62 years of investing in those projects, we have always been profitable, right? And have grown tremendously. And now as we go more into the market creation and project development, over time, I expect exactly the same to be the case. So because there is money to be made, and you obviously they will have to take higher risks, we have come up with some mechanisms again to de-risk those investments in challenging countries, or the first of its kind type of investments. And it's going pretty well. I mean, we have a way to use some of the donor funds to de-risk those investments and mix those funds with our more commercial financing. And then we have also found a way to create platforms, which we call managed co-lending portfolio platforms, when institutional investors put their money in and automatically co-invest with us. So we identify the sector, the project, we develop it, we de-risk it, we bring our own commercial financing in, and then automatically deploy some of those institutional investors' money. So for them, that's kind of an easier way to get in rather than to go project by project and experience all these issues and risks that I talked about in the case of Nepal by themselves directly.
So in our final minutes, I wanted to talk about how impact investing, and you already touched on this, but how it can help address what is obviously the great existential crisis that we all face, which is climate change. You mentioned green cities. We know that by 2050 or so, 70% of the population will live in urban areas, up from around 50% now, and a lot of that urban area is still yet to be built. So climate considerations have to be factored into, or we're in even bigger trouble than we already are, into those projects. So how do you think about that challenge as you think about impact investing?
Oh, absolutely, Mark. And I think it's very interesting to talk about climate change in Asia, which is home to 2/3 of the world's population. Again, 16 out of 20 most polluted cities are here in Asia, and 45% of the global catastrophic climate-related events actually happen in Asia. So we cannot ignore it. And I think the answer is going to be very similar to what I already talked about. I mean, in terms of financing, obviously we see a lot more interest in green bonds, and that will be our way to scale up financing for climate-friendly projects. But I also want to say that there is a lot of work that the regulators have to put in to create some positive momentum and incentivize the banks, financial institutions that are willing to invest in green projects. There is also a role for institutions like IFC to train those banks and educate them on what the green projects are and how non-green projects can become greener and more resilient. So there is a role for everybody in this mix if we're serious about making it happen. And then there is a lot of capacity building with clients themselves. I gave an example of green buildings where we have to educate them and help them make their projects greener. But I think green bonds will help us take the financing to scale. And then on the receiving end, what will be the projects that will be receiving that financing? We need to really work very closely with clients. We need, in some cases, to de-risk those projects. IFC has used the blended finance instrument where we mix, as I said, the donor funds and IFC commercial funds quite a lot in climate projects. They were the first solar project in South Africa was possible because we could use blended finance. The first wind project in Mexico was possible because we could use blended finance. But now UT1, the project in Nepal, is also beneficiary of some of the blended finance. It wasn't possible to structure it fully on a commercial basis, but our hope is, like in what we saw in South Africa and Mexico, that the market picked up, and then the next round of projects needed less blending and more commercial, that we are actually going to create a market for fully commercial space in climate-oriented projects.
So when you look ahead at the scale of the need and the scale of the problem, are you hopeful?
I have to be hopeful because I don't think that, first of all, past is telling us that we can grow, we can develop emerging countries. There are some countries that are stars in terms of development. I'm thinking of Rwanda, for example. Right. Many years ago, nobody would have thought that Rwanda will become what it is now. I think in this region, we have also seen what happened in Myanmar, what kind of turnaround has happened, how much private sector has come in now. So there are multiple examples of countries that where what I'm talking about actually happened. And there is in Asia, what is beautiful in Asia is in my portfolio, I have a mix of countries that are actually from which we can really learn. China is the case in point, where we're learning a lot and we can very quickly implement in other countries that need those solutions. But I want to reiterate, the money is with the private sector, right. So we need private sector and innovation, innovative concepts that will solve some of these development challenges and gaps are going to come from private sector. So for those of you who are from the private sector, a huge role to play, and institutions like us can help connect with governments and regulators.